Thank you very much, Rami, for the introduction. And so, up until this point, hopefully your interest has been piqued. You've heard about our product, you've heard about the potential in the market, our business model, a solid team. So we're very, very excited about this. Obviously, this cannot come to fruition without a sound financial plan. So what I'm here to talk about is what that financial plan is and the request for capital. So first I'm going to talk about our current financing and where we stand right now. Next, I'll talk about our funding needs. And so what kind of funding needs do we need to really get this off the ground into the next stage of success? And then finally, I'm going to tie that to our revenue and expense projections, as well as some sales projections, where you can see what we're expecting to do over the next several years, along with when we would expect to break even. So hopefully that's some very important information to you. And without further ado, let me show you the first slide. So our current financing picture here is broken up into 4 smaller pieces. As Rami mentioned, we have some investment from the small business investment loans. Also the Department of Energy, each for about $1 million apiece. We also have another small business loan separate out there, as well as we've also pulled a lot of our personal capital to get this off the ground and at least get our pilot program going, which has been, as you heard, very successful. Next, in terms of the current funding needs, we actually, as I said before, have the money that we came in with, but obviously we have a gap to be able to expand what we want to do here. So in terms of the totals here, we can see that the venture capital needed is $9.2 million, which means that we have about $12.2 million that we're asking for total. But the venture capital from all of you, we're looking to raise about $9.2 million. So how does that break down? Well, we've done a lot of analysis on what the pieces of the business are and the expenses that we need to start running our business. A lot of this, upwards of $5 million, has to do with materials, and that includes vendors and so forth. And we've done some careful supply chain analysis to ensure that we're doing that efficiently. Some of the other large parts here I will highlight here are the overhead. So obviously we have overhead. We have an additional investment in the business for about another $1 million. We also have wages, clearly, that we need to be paying, as well as a smaller piece here for the actual insurance we need to carry on our operation as well. I'll make sure I can look at the charts up here. And so finally, we talked about our funding needs, but let's talk a little bit about our financial projections. And so you can see with 2009, we have expected revenue of about a little under $10 million. These costs are close to $20 million. So yes, we're investing right now in our business, and that's where we need some of the venture capital to keep this going. If you look towards the end of 2010, you come much closer to a break-even point. Our revenues are making more in the $20 million range. However, our costs are still a little bit above that, maybe about $27 million. However, what we expect is that we are going to break even here at the end of 2010 as we get into 2011. And as you can see, after that break-even point, we're really going to be able to accelerate our growth in terms of our revenue and expenses, and especially the margin that we hit. So our revenue is directly proportional to these sales that you see in the upper, the red line that's going up here. And so as you can see that by 2012, we're making a pretty good margin. By 2015, we're making a significant margin, in excess of 40%. And I think that is particularly intriguing. So what I would like to do is, I showed you a little bit about our current financing, our funding needs, and our projections. What I'd like to do is turn this over to Satya to talk a little bit about the strategy for making this a reality, as well as your potential return on investment. So Satya.